After announcing their quarter 4 earnings, Adobe fell by 11.52%, which means that over the past year they are down by 23.21%. But we can actually see that they beat their earnings expectations by 3% and their revenue expectations by 1.17%. And so the one reason why they are down is their disappointing outlook for 2025. And so today we will figure out if Adobe's drop in price is rational or if it just became undervalued and now is the best time to buy the company. And as always, to do this we will use our stock valuation spreadsheets where we will have a look at the fundamental 9-pillar analysis and calculate the intrinsic value of Adobe using our 4 valuation models. Now moving back to the stock screener, we can see that Adobe isn't a dividend company. They currently don't pay out any dividends. Now, one thing I love about them is their very low debt. If we direct our attention to the market cap right here, we can see that that is sitting at 242 billion, while the enterprise is sitting at 240 billion. So they essentially have only about $2 billion in debt, which is nothing compared to their enterprise value. Now, moving straight to the 9-pillar analysis, we can see that the company gets a rating of 6 out of 8. And first of all, as always, let's have a look at their profits growth. So we can see that their revenue has been growing at a rate of 13.51% yearly over the past 5 years. Their free cash flow has been increasing at a rate of 15.70%, and their net income has been increasing at a rate of 20.67%. Now, if we have a closer look at these 3 metrics, first at the revenue, we can see that that increased from 11 billion in 2019 to 19.4 billion in 2023, and year over year, another 7.92% increase. Regarding the net income, that as well has increased from about 3 billion in 2019 to 5.4 billion in 2023, but slipped slightly year over year. And regarding the free cash flow, that as well rose from 2019 to 2023, but slipped by about 5.65%. Now, the fact that the free cash flow decreased, the net income decreased, while the revenue increased, tells me that the company might have made some bad management decisions. But what I like is that their free cash flow is higher than their net income. Free cash flow is the money that the company can use to buy back shares, pay down debt, invest back into the business, and raise their dividend, while the net income is just a measuring metric. Now, moving back to the 9-pillar analysis, let's have a look at the 2 pillars in the red, and that is the 5-year PE ratio and the price to free cash flow. And what these 2 pillars basically tells us is whether Adobe is under or overvalued compared to their earnings. And so far, it seems like Adobe would be considered overvalued compared to their earnings, as investors are paying $38.88 for $1 of the company's earnings over the past 5 years, which is higher than what they would pay for the average company. And if we have a closer look, we can see that currently the P ratio is actually sitting even higher than the 5-year average, sitting at 41.07. Now, to really understand if Adobe is overvalued compared to its PE ratio, we have to compare it to the PE ratio of its competitors, so Microsoft and Autodesk. We can see that the P ratios of all these 3 companies are sitting between the range of 30 and 60, which means that even though Adobe's PE ratio is quite high compared to the average company, it might not be that high compared to its sector. But we can see that in its past, it did trade cheaper. So there might be better opportunity to buying Adobe in the future. Now let's also have a look at the price to free cash flow, which is basically the same as the P ratio, except instead of the earnings, we have a look at the free cash flow. We can see that this is sitting at 31.94, which is closer to the average stock price, but is higher than the 5-year price to free cash flow. So again, Adobe would be slightly overvalued compared to their price to free cash flow in the past. Now jumping back to the 9 pillars, let's have a look at some of the other pillars. So Adobe has been decreasing their shares outstanding at a rate of 1.59% yearly over the past 5 years, which I very much like. And their 5-year profit margin is sitting well above the 10% we'd like to see, sitting at 87.08%, which is quite usual for a company that operates with non-physical products. And finally, let's have a look at their long-term liabilities over the 5-year free cash flow negative dividends to be sitting below 1.5. We can see that Adobe's is currently sitting at 0.18, which means that they can pay off all their long-term liabilities without an issue. If we have a closer look, we can see that they did increase them by a lot from 2019 to 2020, and there was another quite a big increase over the past 12 trailing months of 12.60%, but their long-term liabilities are still sitting at only about 5.5 billion, which is nothing compared to the free cash flow they generate. Now, if you find these spreadsheets interesting and think that they would help you make more informed decisions regarding the companies you are purchasing, you can always download them in the link in the description. Now, before we calculate the intrinsic value of Adobe, there are a few things I do want to point out. Adobe is facing some uncertainties from the AI era. They are facing challenges with slowing growth rates and AI integration, raising questions about its ability to maintain competitive pricing and market share. They are also experiencing competitive pressure from newer entrants like Canva and OpenAI's DALL-E. But they did make some advancements, particularly in the Firefly platform, which has significantly boosted user engagement and growth. So Adobe seems to be doing a good job moving into the AI era, but we do have to wait a little longer to see if they can keep up. But overall, they have very healthy and high revenue growth, free cash flow growth, and net income growth. Their profit margin is very nice and high. They have decreasing shares outstanding, and I'm really not at all worried about their very low debt. But in my opinion, they are slightly overvalued compared to their earnings and compared to their free cash flow. So let's calculate their intrinsic value first using the Graham's formula revised. And here I plug in the high earnings per share growth estimate at 15%, medium growth estimate at 12%, and low growth estimate at 10% over the next 5 years. I then average this out with the analyst projections and get a 5-year earnings growth estimate of 12.86% yearly. We then take the 5-year earnings per share, the base PE, the growth rate multiplier, the average yield on AAA corporation bonds, and the current yield AAA corporation bonds and get an intrinsic value of $306.22, which is about 60% lower than the current trading price of the company. But we still have 3 more valuation models to go through, moving to the discounted cash flow model. And here we take a look at the free cash flow growth of the company. So over the past, we calculate an average growth of 15.70%, and using the same method as before, I predict a growth rate of 14.3% into the next 10 years plus. We then have to plug in a discount rate, which I plugged in at 10% based on the WACC of the company and based on the minimum return I would like to see from an investment into Adobe. And using this, we calculate the present value of that future free cash flow. We then sum all of that up, add cash and cash equivalents, and subtract total debt, which gives us an equity value, which we divide by the shares outstanding and get an intrinsic value of $541.56, which is quite higher than the current trading price, and is actually the price at which Adobe was trading before the big earnings drop. Now moving to the third valuation model, the multiples valuation, where we compare Adobe to 2 of its competitors, and we have already somewhat done this comparison, but this is more visual. So taking the company's stock prices and dividing by their earnings per share, we get their PE ratios, which we average out and multiply by the earnings per share of Adobe to get an intrinsic value of $582.56, which is higher than the current trading price, showing us that Adobe wouldn't be considered overvalued compared to their earnings in its sector. Now normally we would also use the dividend discount model, but Adobe doesn't pay out any dividends, so we will skip this one and arrive straight to the ultimate intrinsic valuation, where we will average out the 3 valuation models and get an ultimate intrinsic value of $476.78, which is 1.26% lower than the current trading price. And if you wanted to buy Adobe with a margin of safety of 10%, you would get an acceptable buy price at $429.10, which, if we have a look back at the stock screener, is a little lower than its 52-week low. And with that, I hope that you enjoyed the video. I hope that you found it helpful, and make sure to leave a like and subscribe, as it really helps me out.